Thank you so much for joining us here this evening while we do this. I guess, Michael, we'll call it a semi-emergency fireside chat between Michael Scott and myself, where we're going to unpack the recent events over the last week of, I guess we'll call it a banking crisis. Michael, should we call it a banking crisis? What is this?
I think we should shy away from calling it a crisis, man. I really think it's a crisis averted moment. This this week could have gone much different than it had, and we can
Mm-hmm.
talk about that and reasons behind it. But really, this is turning out to be more news headlines than a crisis.
Good. That's actually a really good perspective to hear because I feel like so much that has happened, even just in the last 3 to 5 years in the markets, a lot of times is sometimes more news headlines than an actual crisis. Can you let's maybe just back up to about approximately a week ago and just explain what happened with Silicon Valley Bank first, and then let's go from there.
Yeah, and to explain this, you really have to understand what a bank does. What is a bank in the business to do? Banks are just companies that take in cash deposits from you and I or from other companies, and they hold them for you, right? Otherwise, we would be holding all of our money and our mattresses, and we don't do that, right? We put them in a bank, and then when we need them, we pull them out. And when you put your money into a bank, banks then loan out that money in a variety of ways. They may do home loans, they may have auto loans, personal loans, HELOCs, different things, and they can also invest their capital in different securities like CDs at other banks or treasury securities or bond securities. They have different things they're allowed to do, and there are different guardrails which they have to abide by. But they earn interest off of those loans. So, we have mortgages. I pay 2.7 on my mortgage, my 30-year mortgage. PNC brings that in. And then whatever they pay as the deposit, they pay their depositors like that small minute interest that we talk about banks pay you. The difference between what they take in and what they pay out is their earnings. And that's generally how banks make money. Now, back to your question, what happened with Silicon Valley Bank? Well, it looks like over the past, it's a little over a week ago now, they there was a situation that came up that caused them to want to raise capital. Why did they need to raise capital? Well, let's call it the 5 years prior to this, Silicon Valley is known to have these startups, these venture capital companies, these new companies that get seeded with a bunch of money. And these companies put their money into this bank. And this bank was making loans to them, whether it's personally on their mortgages or for the business or offering them credit, was making loans out. But the bank also, at that time, began to purchase long dated treasuries. So think 20, 30-year treasury notes. And they, at the time that they were buying them, they bought a lot in 2020 and 2021. Those treasuries, were paying 1 to 2% interest. And we fast forward to 2022, the Federal Reserve began to raise interest rates. And just like you and I and all of our clients paying attention to this saw bond values drop a bit, so did the banks. And a lot of these treasuries that Silicon Valley Bank bought lost a lot of value.
Mm-hmm.
Now, there was no credit risk here, meaning the bank wasn't concerned that they weren't going to get paid back. The problem arose because there was a mismatch of when they would get paid back and when their depositors needed their money.
Right.
And what happened was that depositors at this point in time, they're drawing down on their bank deposits because they're running their businesses. They need to buy equipment, they need to pay their payrolls, they need to pay taxes, they're pulling money out, and not a whole lot of money was going back in because, again, this is venture capital money. It got seeded and now they're using it and they're drawing it back. And it got to a point where what the bank looked like on paper made it look like it was insolvent.
Mm-hmm.
And that's where people became concerned.
I have a question. What and sorry, I didn't mean to interrupt you, but what's different about, and I know the answer, but I want to hear you explain it with Silicon Valley Bank, for example, where they have this, I guess we'll call it like a niche business model where they focus on working with venture capitalists. So they kind of have this unique clientele, and maybe just speak to the differences of like other retail banks, the big names that we think of and know of, that many of us are accustomed to banking with.
Yeah, so there's many differences, and one of the things that a pro for Silicon Valley Bank with working with that kind of clientele is it's ultra wealthy. It's businesses with a lot of money. So there's a lot of perks and a lot of reasons why you would be attracted to it.
Mm-hmm.
The con to that, or the downside risk to that, is that they don't have a lot of what we consider retail depositors,
Mm-hmm.
or people that put their money in the bank and they carry a checkings and savings account balance. Maybe it's in the range of a couple $1,000s to $200,000, right? For most people don't change banks often. Why? Because it's messy, right? You have to change your automatic deposits. You have to change your how you pay your bills. If you have direct deposit for your electric bill, you have to change that. It's a pain in the butt to do it, to change a bank. So
Mm-hmm.
most retail depositors are sticky, meaning their deposits don't leave. They may pull money out on a monthly basis, but they put it back in with their paychecks.
Mm-hmm.
Silicon Valley Bank did not have a lot of those depositors. It was something like less than 10% of their deposit base was of that nature, meaning they were very susceptible to a large amount of money leaving in a quick period of time. And that kind of goes into what happened was that a lot of these venture capital companies, when they heard that the bank was potentially insolvent and that it looked like they might have a problem, they pulled their money in a very quick period of time.
Mm-hmm.
In about 48 hours, north of $40 billion was pulled from the bank. And
Wow.
then on Friday, there was close to some reports of about $50 billion being queued up to go out. And of a bank that only has 200 and some billion in deposits, that's potentially 25 to 50% of your deposits leaving in a 72-hour period.
Right.
And it kind of turned a situation that Silicon Valley Bank probably could have escaped from initially into a situation that was not going to be rescued. Bank
Mm-hmm.
runs are damaging because that's a lot of money leaving in a short period of time, and there's almost nothing you can do at that point to stop it. And that's why the feds ultimately stepped in.
I think it's helpful insight to understand that, obviously the rising interest rates, like them having long term bonds on their books, has an impact as rates rise. But I think their business model being different than most banks is also important to get. But can you also explain for us listening the importance of the FDIC? I mean, I want to make sure we explain how FDIC insurance works, but also the importance of what regulators did when they came in and backed the bank, because I know that was potentially a concern of like, how are they going to handle this, and depending on how they handle this is had big implications.
Yeah, I mean, how they handled this is arguably more important than the bank failing.
Wow.
That for the global economy and for the United States economy as a whole, the actions that were taken over the weekend were incredibly important. So, FDIC insurance says that for any individual, if they own a bank account or of some sort at a bank, your deposits are guaranteed up to $250,000. That's $250,000 per depositor per institution, right? A married couple each gets 250. So a married couple could potentially have 500, right? That is paid for by the banks out of their fees and expenses that goes to the FDIC. And what happened here was that over the weekend, the the federal government stepped in, the FDIC stepped in and made the decision late Sunday night that they were going to guarantee all of the deposits at the bank, not just those under 250,000. Why that's key to understand the situation is is that if that did not happen, other banks would potentially experience runs. And instead of only having one bank having a run, and we can talk about the signature bank issue later.
Sure.
That's kind of a cherry picked situation in itself. You would have had multiple banks experiencing a bank run, a rush of people. If you weren't banking with Bank of America or Wells Fargo or JP Morgan Chase, if you were banking with these regionals or credit unions and you had more than 250,000 in your account, you begin to wonder, is that money safe? So the Fed stepped in and decided to guarantee everything. And in doing so, kind of gave this implicit guarantee that bank deposits are safe. Now, are they not? We can have this discussion. But for us, one of the key takeaways that I have is, why worry about that? And I say that because if you're someone who has more than 250,000 in cash in the bank, you could easily mitigate that by taking cash out of that and putting it in your brokerage account and owning something like a money market or a US Treasury. Now, I'm not going to sit here and say that the things are equal, right? Because a Treasury and a money market, to be clear, does not have FDIC insurance. But a short dated United States government Treasury is backed by the full faith and credit of the United States. So you don't have to worry about it being in a bank.
Yeah.
You own the Treasury. You're only concerned with two things, when it matures, because it's going to, and the interest rate you buy to that, right? Those are the only things you worry about at that point. And money markets, similarly, are backed by short dated treasuries and commercial paper and very high graded debt securities. So, for myself and for you and for everyone listening, it's almost, it can be a non-issue what the FDIC limit is if you structure your assets in the right way.
Yeah, I think saying that another way is focusing on or understanding the importance of diversification, which was really kind of the second. I always like summarizing things in actionable takeaways. I think the first thing was really important for everyone to understand how FDIC, like how that insurance actually works. So that's a good reminder. And then secondly, the importance of diversification as it relates to this whole situation. And I do, as we'll try to be mindful of time. But as we're maybe coming to a close, can we maybe just shift the conversation? And I'll ask the final question. Like Credit Suisse, for example. I mean, are we worried about this being a contagion situation, or is it really, maybe more? And I know this is a hard question to answer, but is this a hyper focus issue to one bank, or are we now going to start having to worry about multiple banks? And even as we're recording this, I think there's information coming out about First Republic this evening. So what are your thoughts on that front?
Yeah, let me answer a highly complicated question in 30 seconds.
Leave it to me to ask the hard questions, not answer the hard questions.
Yeah, so at the moment, it looks like the situation is contained, right? And facts can change at any point in time. But let's split this out into three different issues, right? Silicon Valley Bank is an example of poor risk management by the bank to align the deposits that they had with the investments that they were making, right? There was a mismatch there, and that was poor management by the company. Credit Suisse is a bank that's been around for 150 years. It's located in Switzerland. It has a great wealth management business. It has great international operations, but it has been poorly managed for years. And actually, that bank is sound. It is solvent on paper. It's just managed poorly from a business perspective at the moment. Like, it just doesn't have great earnings. And all that happened was that the Saudi National Bank, who is one of their biggest funders, came out and said, we can't inject more money into the bank because we are at a limit regulatorily. Like they have 9.9% ownership stake. If they go above that, there are certain things that they'd have to do and disclose that they don't want to do.
That's an important distinction, though, because I read an article that maybe made it sound more like we won't inject more money versus we can't inject more money, and that's a big distinction to understand.
And they actually came out and clarified that they don't expect Credit Suisse to need to do more capital raises or things like that. The bank on paper is solvent at the moment, and facts change, right? But at the moment, that's a separate one-off issue. And then moving forward, like the developments that we were talking about and seeing in the market right now, First Republic was a bank, or is a bank, that looked to have some similar type holes that probably Signature Bank did and Silicon Valley Bank did. Yeah. But what we're seeing is instead of that bank being closed or sold off, other financial institutions are coming in and they're going to inject it with capital in the form of deposits. Meaning, and I don't mean to quote me here on this, but a bank like JP Morgan offered them a line of credit and is now going to open up an account with them and deposit billions of dollars to show a sign of belief. And it looks like reports are coming out that about $20 billion of equity or of capital in that manner is going to flow into the bank and help to stabilize it. So that bank looks to be fine as well. So what we're really seeing is a couple examples of poor risk management by banks, not an indication of financial crisis that we saw in like 2008, where it was systemic and there was major counterparty problems everywhere. This is a highly, highly concentrated, different type problem.
So that's really helpful. Yeah, go ahead.
I was saying overall, just in closing there, the U.S. financial system and the banks are well run and more well capitalized than they ever have been before. Silicon Valley Bank was a specific niche bank that did not manage itself correctly. Yeah. And it's not a 2008 type situation.
Yeah, thank you for clarifying that, because that was actually going to be my final question to you, and you answered it before I could even ask, which is this looking like a 2008, which was a completely different type of crisis, and at the moment it's not. And I really feel like, just to summarize the conversation today, some of the key actionable takeaways that we should be focused on, and you can correct me if I'm wrong, but again, a reminder or an understanding on how FDIC works, focusing on having this conversation around diversification. The old adage of don't put all of your eggs in one basket very much exists still today, and especially in this circumstance. And then I think last but not least, communication. Michael and I will be doing these, I would say, periodically over the coming weeks to months, just as the situation develops, to stay in touch with folks. But communicate with your advisor. Most people watching this, we work with. We're recording these for our community of clients. But if we don't work with you, communicate with your advisor. And for us, it's I find that communication and education is half the battle. To read the headlines of what I see in the news, and then to have these types of conversations with Michael and understand what's really happening. Those are two very different things, I feel. Michael, anything you want to close with?
I think you summed it up pretty well. I'll just say that, this event it is a lot of headlines in all actuality. Now, it could have been different had the government not stepped in and done some of these measures. But, a key takeaway is that a lot of this is headline, and it is not systemic problem. Things can change, but at the time we're talking about this, recording this is a lot of headlines and very, it's going to be a great case study in graduate school at some point for some kids. But right. At the moment, that's all it is.
And as you said, things can change, and if they do, and as they do, we will keep you posted of the situation, and we'll continue to do. You're going to be hearing a lot of Michael and I over the next few weeks to months as things develop. So we'll stay in communication and in touch with you. Thank you so much for watching this video with us today. If you have any questions, either below that or somewhere close to proximity to this video will be a link to schedule an update call with us. So we look forward to talking to you then. See you, everybody.
See ya.